At Insightful Value, we shine a light on companies the market might be sleeping on, and Piaggio CSPA is a perfect example. The stock price looks cheap, but what's really under the hood? Is this Italian icon quietly undervalued, or is the market seeing something we're not? This review is for informational and educational purposes only. Nothing here is financial advice. Piaggio is one of Europe's oldest and most recognizable mobility companies, famous for its Vespa scooters. But today, it's much more than just vintage two-wheelers. Piaggio operates in over 100 countries and owns brands like Aprilia, Moto Guzzi, and Derby, along with commercial vehicle lines like the Piaggio Porter. They've positioned themselves as a leader in the two- and three-wheeled vehicle market, and even expanded into electric mobility with the launch of electric scooters and hybrids, aiming to stay relevant in an evolving urban transport landscape. In 2023, Piaggio reported over $2.1 billion in revenue and posted a net profit of around $90 million. Despite inflationary pressure and global supply chain issues, they managed to maintain a decent EBITDA margin of about 14%. That's not bad at all for a traditional manufacturer in a highly competitive space. Their balance sheet shows a manageable level of debt, and their operating cash flow remains solid. What's also notable is that Piaggio pays a dividend, and it's been growing. Over the last 5 years, the company has consistently returned capital to shareholders, with the current dividend yield hovering around 5%, depending on the share price. That's quite appealing for income-focused investors. So why is the stock trading at a relatively low valuation? There are a few factors. First, the market tends to undervalue European small and mid-caps, especially industrials. Second, Piaggio operates in a segment that's seen as old-fashioned, even though they're quietly innovating. Third, recent economic uncertainty across Europe has weighed on consumer discretionary companies, and especially those tied to vehicle sales. But dig a little deeper and there's more going on. Piaggio is pushing forward with smart urban mobility initiatives. They've expanded their presence in Southeast Asia and India, where scooter demand remains high, and are focusing heavily on electrification and connectivity. They've also formed partnerships in robotics and AI to integrate smarter systems into their vehicle design. On the risk side, Piaggio does face exposure to global economic cycles, currency volatility, and regulatory challenges in emissions. Plus, while their move into EVs is promising, they're still competing with giants in the electric mobility space. But from a value perspective, this is a company with strong brand equity, consistent profitability, healthy dividends, and a forward-looking product strategy, all while the stock trades at a low PE ratio compared to peers. That combination is why Piaggio might be worth a closer look. At Insightful Value, we break down companies like this so investors can better understand what's really happening behind the scenes. Whether you're building your first portfolio or refining a mature one, our goal is to make investing clearer and smarter. For more deep dives like this, check out insightfulvalue.com, where we post frequent research on undervalued stocks with long-term potential. And if this video helped you see Piaggio in a new light, subscribe to our channel and hit the notification bell so you never miss an update. Also, visit insightfulvalue.com for more data-driven stock insights and simplified investment research.